I'd like to call this meeting to order. If everyone could please rise for the Pledge of Allegiance. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Welcome, everyone. Let's start with the roll call, please.
Bozak.
Present.
Regna. Here. Biggs.
Yes.
Morales. Vasquez. Jones.
Here.
Harris. Here. Rivas.
Here.
Shem.
Present.
Brookner.
Here.
Missing two.
And Councilman Vasquez should be here. He will be here for the council meeting. He hopes to make it here for foundation. Okay, first up, we've got the approval of minutes for February 25th, 2025. Do I hear a motion?
Make a motion.
Second.
We've got a first and second. Any discussion? Hearing none. All those in favor signify by saying aye.
Aye.
All those opposed, same sign. Motion carries. Next, we go to our capital cities presentation.
Okay. Good afternoon, everyone. Oh, is mine on?
Is it green?
There we go. Good afternoon, everyone. My name is Amanda Black with Capital Cities. I do have a couple of things to cover with you today. I'll bring you up to speed on the quarterly performance and tell you how the foundation is doing from a return standpoint. I have our normal annual portfolio construction study where we look at the asset allocation of the funds and make sure that everyone's still in agreement with the approach that we're taking. And then we do have a couple of slides at the end to show you on the impact of the one-time increase in the annual spending. I'll show you that. And along the way, I do have one recommendation that will require a vote. We are recommending replacement of one of your equity managers as part of tonight's agenda. So I will start by covering the performance. So if you'll please just advance the slide. First, I'm going to show one more, please. I'm going to land here for a second and talk about the market performance during the first quarter of 2025. So we did see a reversal in the investment markets during the first quarter. When I say reversal, I mean a reversal from what had been trending for the prior 2 calendar years. So for the prior 2 calendar years, what we had been seeing was really a risk-on market environment where the companies with more growth aspects within the equity market had higher returns. So larger company stocks, growth stocks, especially like tech stocks, really led the way predominantly for almost 2 calendar years. We saw a reversal of that in the first quarter as the volatility entered the market, uncertainty around tariffs, uncertainty around what the Fed would do with interest rates as they try to balance inflation, growth, and jobs. And that led to some kind of mixed results within the market. You can see those results here on the page. The middle chart just shows different styles of equities or stocks during the first quarter. The only positive spot of the U.S. markets was large cap value stocks, again, a reversal from large cap growth leading the way. And then you can see across the board, those blue bars, lots of negative returns across the U.S. equity market. We did also see a little bit of a flip-flop in terms of non-U.S. stocks outperforming U.S. stocks. So those stocks outside of the U.S. were generally positive. We did see some nice returns in fixed income or bonds at the bottom of the page. We typically talk about the broad U.S. fixed income market by looking at the Bloomberg Aggregate Index. That index was up 2.8% for the quarter. So the tough market for equities, a little better for fixed income, and then we continue to see volatility here in the second quarter, as you all, I'm sure, have seen in the headlines. With all that said, I'm happy to report that the Porter County portfolio has held up very well. Let's go ahead to page number 6. The bottom of the page, it says page 6. Yeah, thank you. So here we see the snapshot on the Porter County Foundation portfolio. You ended the period, that blue row, at $186.8 million. You did have a return, a positive return of 1.4% for the quarter. So I showed you kind of those different returns a second ago. What was really helping your portfolio were some of your active equity managers, those who didn't put all of their eggs in one basket, so to speak, those who were investing outside of those tech names. So those were some of the managers that did better. We also saw strong performance out of your non-U.S. equity holdings, even though it's a smaller part of the portfolio, and your fixed income did very well. So you came away with a modestly positive return of 1.4%. That did outpace your benchmark. So had you just been passively invested for the quarter, your return would have been negative 0.1%. Kind of hard to see on that page, but that benchmark is basically flat. So almost about 150 basis points of outperformance versus your benchmark for the quarter. That brings your last 12-month return to 5.6%, which is still a little bit shy of your benchmark. If you would please turn a page to page 7. Here's where we have your stoplight grid. This is where our team assigns a qualitative and quantitative rating to every one of your underlying investments. Yes.
Just a real quick question. On the previous page, page 6, it had a negative 0.6 and a red under differences. Is that something we need to be concerned with rebalancing?
No, great question. So that table on page 6 ties back to the strategic target allocations of each of the broad components of your portfolio in your investment policy statement. Cash was a little bit lower. It dropped below the 2% target, but not to a point of warranting any action. There are ranges that we allow them to deviate, and that's just normal. So on page 7, we have these different stoplights. Anytime there's something that doesn't have a green stoplight, we explain it in the text below. One of those is the AQR Large Cap Defensive Equity Fund. It has a yellow light for short and long-term underperformance. That's one of those funds that has very little exposure to technology stocks. That held that fund back in 2023 and 24, but it was your top equity performer in the first quarter of 2025 within the U.S. segment. The other one, so we're not as concerned about that. We'll keep watching it, but we expect it to diversify some of your other holdings. The last one on there you'll see red lights for. That's the Wasatch Ultra Growth Institutional Fund. That fund has been on watch list status. The fact that we've changed those lights to red indicates that we're recommending action. So we are recommending termination of that fund, and we have a couple of other funds for you to consider that I'll show you here in a second. So on page 8, you can see some longer-term returns. I talked about how you have very strong performance for the quarter. I know it's just 1.4%, but there were many investors in the negative space for the first quarter. So 1.4 was a strong return. But if you look across that page, you can see longer-term figures. These are all annualized. So for instance, on a 5-year basis, quarter has an 8.4% average annual return. And then since inception of this foundation portfolio, the average annual return has been 6.5%, which is outpacing both your benchmark and your original performance target of 5%. So very pleased with the results. I know that we never want to focus on short-term performance, but with all of the volatility that we've seen in 2025, I'm very pleased to report that you continue to have a positive return here into the second quarter. So doing well despite these sort of rocky markets. And that was even before what we saw today. On page 10, actually, I'm sorry, you could look at 9, thank you, right there on page 9. Here you'll see a very large outflow. This is the physical distribution of that $8.9 million annual cash flow. So this was determined at the end of the year, but between Cap Cities and your team, it physically was withdrawn from the account in March. So that's now in the county account. So $8.9 million, again, that's that special 5% spend for the results based on 2024. And then finally on page 10, this is where we show you the long-term cumulative growth of these assets. So I told you you've had an average annual return since inception of 6.5%. Let me make sure I told you that right. Yep, 6.5% on an average annual basis. When you look at page 10, that corresponds to a cumulative return of 76% since inception, and that represents $95 billion in investment gains over that time period. So really pleased with the strong results. Despite the kind of uncertainty and volatility in the markets, we were very pleased to see some of your underlying managers really show diversification. Some that had been trailing in the momentum-led markets really reversed course and became kind of the outperformers during early 2025. Any questions on performance before I switch gears to the next presentation? Okay. All right, so behind your tab in the book, and then perfect. If you would, please go to page 3. So here's where we look at your asset allocation, so your mix between equity and fixed income. We update you on what a normal forward-looking return might be for these assets. We talk a little about what that means relative to your spending policy, and then we have this kind of formal opportunity as collective stewards of these assets to see if there's any changes that we feel are warranted. Now, off the bat, I'll tell you that we're not recommending any changes to your asset allocation, but we do feel like as fiduciaries, it's really important for us all to look at this on an annual basis. So on page 4, basically, we have this kind of formula where, in a perfect world, your return of your portfolio would outpace your spending plus inflation. We're able to estimate what your return ought to be. We know spending is 3.25%, and we can also estimate inflation. So this is a way for us all to kind of do a check to make sure this portfolio is meeting our needs. So I use the capital market estimations on page 5 to populate some of these figures. So for your reference on page 5, we have, for instance, broad U.S. equity is expected to earn about 7.35% going forward. U.S. fixed income is expected to earn about 4.75%. And then inflation on a longer-term basis is expected to be about 2.5%. There's a lot of other detail in there. So then on page 6, when we take your portfolio's strategic asset allocation that this group has decided upon, and we use those figures to kind of come up, we can kind of estimate the return across asset classes. We come up with an expected return for this portfolio of about 6.6%. Last year when we did this same exercise, that number was about 7.0%. The only difference is that economists have brought down return expectations just a shade across the board. So nothing has changed in your portfolio, just the estimations have come down a bit. So then on page 7, again, we're kind of simplifying the math here, but if you're expected to earn about 6.6%, we want to make sure that's enough to accommodate your 3.25% spending plus inflation, and it is, and that's a very good thing to see as fiduciaries. I will tell you that many foundations, endowments across the country are struggling with this situation right here because they have spending policies of 5% or above. So the fact that you have a portfolio that meets your risk tolerance needs and also your return needs is very positive. So from that perspective, we don't see any sort of changes that are warranted here, but I want to pause and see if there are any questions. Okay, so the asset allocation is the most impactful decision that we all make about these assets in terms of the risk and return. Beyond that, if we could please go to page 10, the next kind of order of magnitude decisions that we make is what style of assets should we use in this portfolio. And that's what is depicted on page 10. So the blue pies are your pie slices are your equity components of your portfolio. You have components of U.S. equity, non-U.S., albeit at a smaller level. You have active equity, where there's active management by a manager. You also have passive management, which is just reflecting a benchmark or index. So you have all different styles at work. You have large company stocks, small company growth and value, et cetera. So very diversified equity exposure. On the fixed income front, we take the same approach toward diversification. So the green slices are all of your fixed income. You need your fixed income to perform different roles for you. So you have some more income-generating fixed income. You have some that's kind of more defensive or more of a ballast, some for more liquidity and so on. So those are those different slices you see there. On page 11, we go into some detail on how those different components worked for the foundation during 2024 and into 2025. And really everything met expectations. For instance, passive equity generally led the way in 2023 and 24, but your active managers generally did better in 2025. Within fixed income, your managers that have less interest rate exposure really diversified those that do. So we've really seen diversification at work here, and we have no changes recommended to the styles in place here in the portfolio. So then finally, where we do have a recommendation is in terms of the order of magnitude of decisions that you make, we do have a recommendation for one of your specific managers. So of course it's important which managers you use, but it should be less impactful to the bottom line than how much equity, so to speak, versus which equity manager. Nonetheless, on page 12, we are recommending that you terminate the Wasatch Ultra Growth Equity Fund. This is the smallest allocation in your portfolio in terms of equity funds. That is because inherently we do know that small company growth stocks are the more risky part of the stock market, so it's a smaller piece of your overall pie. But this fund has had very challenging performance. We've been disappointed in its performance relative to its benchmark and peers. There was explainable performance kind of when the market moved on it, but then when the market moved the other direction, we expected it to benefit, and it did not. And that was a sign to us that it was time to find a replacement manager. So it's our job as your consultant to bring these to the group. We do not have discretion to make this change for you. So we are bringing this to you as a recommendation to replace this fund. So on page 15, we have done a search within our team, a small cap growth search, because we want to replace it with another fund doing similar things. And we've narrowed that list to 3 managers. We have William Blair, Congress, and Stevens. So what we did was we did a screen of all of the small company growth stocks in our database. We looked for strong performance, risk-adjusted returns, long track records, stable teams, appropriate expense ratios, and then as we narrowed that list, we got into more qualitative data. So those 3 finalists that you see here, any one of these we think would make a strong replacement, but we do have a recommendation that you choose Stevens. That's just to kind of help move the process along, but if you want to debate all of these, we're also happy to do that. But let me tell you why we especially like Stevens. So Stevens is employee-owned and operated, and small company growth stock picking is all they do. So they don't have fixed income funds, they don't have international. So all this company does is everybody on their team, all they focus on are choosing stocks within this little niche part of the market. Since this team and fund and company was formed, nobody has left the team, so there have been no departures of any key portfolio managers or analysts. We like that the portfolio is diversified. So we don't want it to be so diversified that it looks like an index fund, but we do want it to be diversified enough that if there are a couple of underlying companies that have some bad news, it doesn't pull down the performance of the whole fund. So it is about 90 stocks in the fund. The expense ratio is 1.05%, which is basically exactly what in line with what you were paying before. and they have had very strong risk-adjusted returns over time. Another thing we like about the approach that they take, this is small cap growth, so they are looking for names that have an opportunity to grow. That is inherently risky, but it is also an important part of a portfolio. So what they are doing is they're allocating a sizable piece of the portfolio to companies that are already exhibiting strong growth and strong free cash flow. Then they take the other portion and allocate it to ones that have kind of a need for a catalyst. Like maybe they're working on a new product, and if that product launches successfully, they could have very sizable growth. So they're kind of basing their portfolio into two categories of growth, kind of steady growth and then possibilities for outsized growth. And by having both of those, they've shown an ability to have a more kind of consistent return stream over time relative to peers. So we have a lot of detail in here. And you don't need to go to the back, but just so you all know, there is a grid in the back on page 21 that has a lot of detail about each one of these funds, like the portfolio managers, the tickers, the expense ratios, the number of stocks, the PE ratios, all these things. But I'm trying to give you some high-level information here first. On page 16, we have performance detail. So basically, the Stevens Fund, for instance, has ranked in the top third of its peers over all the time frames we're showing here. Over 7 years, they've had an average annual return of about 7.8%. We're just really happy with the risk profile of this fund and an inherently sort of risky part of the stock market.
So Amanda,
Yes.
we're looking at page 16 and we're looking at all these different
Yep.
charts and graphs. I mean, to me, Congress sticks out
Yes.
really on all outperforming in all these different. I mean, why even so you just said 7 years,
Yep.
7.78%. Congress has 12.6% return. Why
Yes.
Stevens and not Congress?
So the Congress portfolio is concentrated. So it has 40, actually, you know what, let me give you the right numbers now that I'm looking at it. So Congress has 40 stocks in their portfolio, so they're concentrated. Stevens has 104. I said 90, I'm sorry, it was 104. So you are absolutely right. Congress has had better past performance. We are concerned that they are more likely to have a volatile performance path. So what we did, we had pretty extensive debate amongst our team on this. We ran Congress's performance on a quarter-by-quarter basis, and we ranked it relative to peers. Every quarter, they were either top of the peer group or bottom. And for that reason, we felt like that level of volatility, even though it has worked for them, made us uncomfortable recommending that to a group of stewards of assets because, and this is up to you to help me decide here, it's your decision, we don't want this group talking about Congress every quarter. And we are afraid that that could happen with the type of performance they display. So they're inherently more concentrated. For anybody who doesn't know what that term means, it means they put their eggs in fewer baskets. So they only have 40 stocks. So that means each stock has a bigger percentage in the pool. So that if something good happens, that means their performance is even better. But if something poor happens to one of the stocks, it's worse. And we were concerned about that kind of volatility.
Feast or famine?
Yeah, so exactly. So for instance, like look at the calendar year chart on the bottom left. Like Congress had a return of 39% in 2021. And so that's absolutely driving some of their returns. But what you're not seeing are like the quarters when they were negative and everyone else was positive. So they've proven the ability to do it well, but we are concerned about what that looks like going forward, just from a fiduciary kind of monitoring perspective.
But even in like 2022, you're saying the bottoms are worse than others, but they weren't the bottom in 2022. They're not the bottom in the last quarter.
You are right. So and I was talking more quarter by quarter. So that is, if we want to pick solely on past performance, we would choose Congress. Congress based on that solely, yes. So we can do that. I mean, it's a finalist, they're a finalist. I just want to warn you that you would expect that level of volatility going forward with such a concentrated fund.
What fund, like, what are the 40, you know, like what?
Sorry, I don't have the name, I didn't print the name. The 40 stocks, we could look it up, I mean, you would see the top 10 on Morningstar, but, so like, for instance, I could follow up with that, but there are 30% of the whole fund is in their top 10 holdings, just by weight. So that's just the nature of a more concentrated fund. To me, this is something that if I had a personal account or maybe a self-directed brokerage in my 401k, I would maybe look at Congress, but it gave me some pause putting it in front of a group who only meets quarterly and have to, decide how to spend your precious time in these meetings. But that's just totally up to you all to sort of debate.
Just bring it up in there.
Yeah, it's a great point. You're absolutely right.
All right, do we want to make a move now? Do we have any motions? It looks like we just need simple majority if we wanted to get rid of Wasatch. So if you guys would like to make a motion, or do we want to
I
stick
move
with?
that we terminate the Wasatch portfolio.
Okay, we have a motion.
Second.
We have a motion and a second. Any discussion? Hearing none, I assume this is a roll call type thing? Let's do roll call first.
Bregman.
Yes. Brendan.
Yes. Big.
Oh. I apologize. Yes, might help if you use the first names. Just saying.
James D.
Thank you.
Your answer is?
Yes.
Redstone.
Yes.
Michelle Harris.
Yes.
Jerry Rivas.
Yes.
Greg Sims.
Yes.
Mike Fritzner.
Yes.
And Andy Bozak.
Yes. Okay. Motion carries. Next, do we want to replace it? I assume we need to move that money somewhere else.
I'll tell you, I was thinking the same thing Jerry was thinking. I think if this board has, you did give us 3 options. Again, I know
Yeah.
why you did it, because it's more consistent, and you don't want this board kind of freaking out, going, oh my
Yeah.
God, it's down 10%, this one's only down 3%.
Right.
But, I would have, personally, I would have no problem just looking at it, like I said, just for 25 minutes, but I'd have no problem doing that, or
Yeah.
Stevens, so.
I just want to make one comment in that, just in my experience as a financial advisor, when I had a client that said, yeah, I want to be aggressive, and then we would go into a portfolio like this, and we would see that kind of volatility, and then you find out how aggressive they really want to be, and they usually don't. So that is why you have somebody that's doing the kind of investigation to present both sides. You have a portfolio based on past performance, which is no guarantee of future performance, that has outperformed, but as Amanda mentioned, every quarter they could be top or bottom, top or bottom, top or bottom, but they managed to eke out a win year after year. And so it really is up to us and how we feel about, I know we were making comments about Wasatch before too, that it was struggling, and we decided to keep it. So we might end up, Congress could be another Wasatch forward. We like it one quarter and we hate it the next.
Right.
Amanda, I have a question.
Sure.
If you look at, go back to page 7, or expected return relative to foundation's needs.
Yes.
If you look at those numbers, can we afford to be a little risky?
Can you afford to be risky?
I mean, well, if I add up all these numbers here, spending, expenses, inflation, according to the return, I mean, we're pretty close.
Yeah, so I think what whether you choose Stevens or Congress should not impact these numbers. These numbers assume that you have a component allocated to small cap growth. And so that, it shouldn't move the needle. And so in my opinion, that's where, if it's not going to move the needle dramatically, we don't want it to be a problem child. We want it to do its job. But if you want to, but obviously we put Congress in here. I mean, it's a great fund, it's a great firm. Just the volatility gave us pause.
Okay.
I don't think that especially answers your question, though.
Well, the question was, actually, is if we were to pick Congress,
Mhm.
and if Congress happened to hit one of those bad quarters, would it affect this much?
I mean, hopefully you're not, if you're not looking at it quarter in and quarter out, I mean,
Yeah, because
Small
we do
allocation.
It's so small.
I think it's $5 million.
it's five,
It's
$6
$5
million.
million, so the
Right.
overall portfolio, that's why I
And
said,
we look at it.
I know we want to look at real estate, so I'm saying if we want to get a little risky, maybe, you know, this might be the way to kind of eke out a little bit of a gain, but I get it, it's all, you know, on risk tolerance of everybody's, you know.
But looking at past performance, it's only been negative 1 year, and it was the lowest, or second.
I thought actually pretty good.
Yeah, that's what I'm saying.
That's what I'm saying, right.
I mean, I'm willing to personally have a bad quarter because the year's great. I mean, who cares if you have a bad quarter if the year ends great?
Well, and what is the worst that happens if it's not
We look at a year. so we
voting
don't-
well?
Yeah.
Then we,
Well, I do meet quarterly, yeah, we do meet quarterly.
right. So if it wasn't,
Then it
after
would
2
be-
quarters you were not pleased, or.
Then it would be yellow on our sheet.
And we have to be more patient.
And Michelle brings up a good point.
Yep.
If a couple of quarters we don't like the way it's going, we can always change it,
Right,
right?
absolutely.
With risk comes reward.
That's right.
And I just like, maybe I'm wrong, I just typed it in my phone real quick, it says the top 10 holdings are Apple, Microsoft, Amazon, NVIDIA, I don't know what BP said incorporated.
That would be for small cap, right?
I have to say, that's not very small.
Is that right or no?
That doesn't seem right.
Okay,
given
that's why I-
But I don't, let me see if I get the same thing here.
Okay. So do you want to get an answer on that before we make a motion, or do we have any?
I mean, I would be interested to see, I mean, especially if that's 30, 40.
If Jeremy will make the motion, I'll second it.
Are you making the motion?
Well, I mean, I'll give you time, can you look at it up?
I'm not trying to rush you, I'm sorry.
We just want to make sure that we don't have those same stocks duplicated in this.
Okay, no, they're small company stocks that I personally don't know, so I shouldn't, right? Stride, InterDigital, Consult, Ligand Pharmaceuticals, Ollie's Bargain Outlet, Badger, Meter.
Ollie's.
I know I'll work.
You do? Knife River Holding, CSW Industrial. So
Those are the
I'm glad to
top
hear,
10?
yes, I'm glad to hear that they're not the ones you originally said, that would have really concerned.
But maybe there's a Microsoft in one of those.
Yeah, there you go.
Well, that's what they're going for, right?
Would anyone like to make a motion?
I mean, I was just bringing it up, I mean, we have a financial advisor too, I mean, made a recommendation, I was just looking at the.
I agree with you, so,
Yeah.
I mean, the thing about it is us being mostly politicians, no one wants to make that thing, because then everybody's gonna
Well,
say, see, you.
I'll make a motion, I'll do it.
Amanda made it very clear. Any one of the three would be
Yes,
fine.
absolutely.
Yeah, they're all good, or.
It's not the richest thing I've even done
Councilwoman
today.
Harris?
I'll make a motion that we move to buy Congress, or move to, or whatever stuff, portfolio investments in Congress.
I'll second.
Okay, we've got a first and second, any discussion?
Yeah, for discussion, this will not be on me if it loses.
There you go with your conviction.
There you go.
You know,
Knock it in. Okay.
On the other hand, if
Matter of fact, I'm voting against
Yeah,
it.
I would like a party for Michelle and I.
Any further discussion? Hearing none, roll call, please.
Fred Stone.
Yes.
Michelle Harris.
Yes.
Jeremy Rivas.
I won't open my mouth up here again, man.
Oh, it's fine.
Yes.
Frederick Sims.
No.
Mike Brickner.
Yes.
Andy Bozak.
Yes.
Barb Brennan.
Yes.
Jim Fish.
Yes.
Motion carries. Thank you.
Thank you all, I appreciate that, I appreciate the discussion. The team will be excited about that. I'm curious about that, they will be excited.
Well, I'm just assuming you brought three names to us, and you stated.
Yes?
Yeah.
Any one of the three would be fine.
Yes, absolutely, we wouldn't, and we did a lot of work on the search, so we'll be excited to have a client in this fund if we don't have others choose. We haven't gotten to all of our meetings yet, so.
Next up, can we discuss the analysis of impact
Yes.
of a one-time higher spending, 5% versus 3.25?
Okay.
Is that in this?
Yes, it's the very last pages 24 to 25. I was asked to bring a little bit of analysis to the group, just to show you. So let me give you a little bit of background. We have a software tool that uses something called Monte Carlo analysis. Basically allows you to set all sorts of variables, however you wish, and then you can tweak certain variables and see what would happen into the future. It's beyond just looking at like an average or a median. It actually kind of spits out scenarios that could happen based on all the variables, like 10,000 scenarios, and then it takes the median of those scenarios. So you get potentially a more accurate statistical analysis of what could happen in the future. So what we did here is we took your historical market values, loaded them into the software. So every quarter, what was your market value? We also took your asset allocation. So that's the amount of equity versus fixed income, because that's a variable and will change. That pulls in estimations for the market and what they will do. So we have all these different things at play. So then the one single thing, the other thing we can do is put in your spending policy. So that's 3.25%. All of that is the same for both of these scenarios. The only single thing that we did differently is for the orange line, we started it at $3 million less because you spent $3 million more than you normally would have at the beginning of this year. You distributed that extra spend. Okay, so the only single thing that's different between the two lines is that one-time spend. And this is just to show you kind of what that does to the projected future value of your assets. So that's on page 24, and then on page 25, we can project what, so on the next page then, we can project what that 3.25% number looks like in the future in terms of a dollar value. And basically that shows you kind of the slight difference that we expect. Well, I mean, but this is every year in and out of kind of what's happening. I'm afraid I'm not making sense. There's a lot of detail. Basically, we can just project into the future what that impact will be by making that decision. The decision is done, it was made, you can't turn back time. But this is for just kind of rounding out the education around this for any future decisions.
Some of that AI technology?
No AI here. It was very manual on my part, I can admit to that. Any questions about this? Is that?
Oh, that makes sense.
No,
I think that's what we expect
Yes.
to see.
So it's more than just sort of guessing, saying, oh, I think this will hold back this, or oh, this will do that, like we can put it on paper.
And we could also do I'm sure, analysis of if we never spent any of our money right from the
Absolutely.
beginning, where we would be at. But
We
the
can.
reason why we have lower tax, we raise tax, because we actually spend 3.25%
Right.
our foundation income.
So it used to be 5.
Yeah, and they will. So,
Yeah. So that concludes the materials I have today, but I appreciate all the time.
Does anyone else have anything for Amanda?
I own an information.
Okay. Then, next we've got the attorney's report.
Nothing today.
Red, did you want to wait?
Yeah, I did. I wanted to talk about that exact, spending up from 3.25 to
Oh, I'm sorry.
5%. I actually want to make a motion, at this meeting, our next meeting's in June, right?
Pretty much.
Yeah, 3 months from now, so.
That's not you.
Oh, no, no, I calculated in my head, I was looking at the March one. The reason why I would like to make this motion is because I think between, the data center and possible lit raises, I want to be able to, kind of get a feel for the board and whether or not they would like to, raise it from 3.25% to 5% for budget year 2026. So the motion reads as follows. I'd like to make a motion for the foundation to place consideration and vote of a 5% draw on our foundation budget account at the next meeting agenda for the 2026 budget year.
For consideration.
For consideration, just so we can talk
For 1
about it
year?
for consideration.
Okay.
For one more year, not anything more than 1 year, for budget year 2026.
You said data centers. It's not tied to data centers whatsoever.
No, what I'm getting at is, we don't, you know, we haven't even began to talk about lid. We need, in my opinion, we're gonna be looking at August before we talk about this again. I wanna get this on record, so we have this on our meeting, so, you know, whether we start talking about lit, whether we understand how data centers are gonna impact or not impact the community, if they're voted for or against, I think we need to at least have this on the agenda to talk about.
For the next foundation meeting?
For the next foundation meeting, 3 months from now,
Yeah,
yeah,
I'll second the motion.
yeah.
We got a first and second, any discussion?
This motion is just adding it to the agenda. right?
Correct, that's all we're doing is adding it to the agenda, talk about it, and a vote. I want to get it on the agenda just because we have to start moving forward with these conversations, whether, you know, we start doing this every year, whether, you know, we raise lid, whether we start cutting, we have to start having, you know, conversations about what are we going to be doing in the future. And so I just want to ensure that we have this conversation.
Do we need anything more from Amanda? Does she need to come with
Can you just
the
make
graphs
sure-
again?
Can
like
you
this?
show that? Can you show what it would, the impact of doing 5% of that?
Just show, like, kind of on these same sort of target.
Perfect.
Okay.
Yeah.
Any other discussion? All right, hearing none, all those in favor signify by saying aye.
Aye.
All those opposed, same sign. Motion carries.
Thank you, Mr. President.
Okay, next we've got any other matter that would probably come before the board. First, we've got approval of claims in Capital Cities first quarter, $16,250.
Motion approved.
Second.
Okay, a motion and second, any discussion? Hearing none, all those in favor signify by saying aye.
Aye.
All those opposed, same sign. Motion carries. Next, we have the Cat Stafford and Miller invoice. It's the audit of the financial statements for last year, 2024, it's $10,000.
Anyone be opposed?
I second.
We've got a first and second, any discussion? Hearing none, all those in favor signify by saying aye.
Aye.
All those opposed, same sign. Motion carries. Any other members have anything that they want to bring up? And hearing none, it's time for public comment. Anyone that would like to comment from the public? All right. I am looking for a motion to
I
end the
make a
meeting.
motion to adjourn.
Second.
Motion second, any discussion? Hearing none, all those in favor signify by saying aye.
Aye.
All those opposed, same sign.
Aye.
Motion carries, have a good day.